And we are starting. Thank you for your time. Thanks for being here this morning, spreading so much knowledge, pouring into me. I'm super appreciative.
Thanks for having me.
It's Jamie Mason, highly accomplished, highly successful. I think he closed about 20 this month. Well, not closed, funded about 20 this month. That's what it looks like to me.
I
Finally this
wish.
month. It looks like it. You are
Yeah.
you are doing awesome, and like I'm really grateful to just have you as a preferred lender on my team, and really work with you and be able to call you at any time and you answer and take the time out. So I'm thankful. I'm super thankful.
Welcome. Thank you.
So tell me a bit about yourself and what inspired you to get into doing mortgages.
Sure. My name is Jamie. I work at Annie Mac Home Mortgage. I've been here about a year and a half now. I've been in the mortgage business about 22 years. I started because my mom was in the mortgage business. And though she told me not to get into the mortgage business, she was like, you're not going to want to do this. I was like, I was working at the time, I think, Circuit City, and I wanted to do something else. Right. So I started as a loan processor in 2002 on the wholesale side. So back then, before the crash, there was a ton of wholesale business out there, right? Like you drive down the street and you'd see a bunch of brokers' offices for mortgages, and then those were our customers. So we were like the middleman. So the customer themselves didn't come to me. The loan originators came to me. That's what I am now, right? A loan originator. So the customer actually comes to me directly now. Back then, I was just the middleman. So the loan officers were our customers and we just packaged up, a ton of business, but then the market crashed and that business kind of went by the wayside. So
Mm,
now retail is, pretty much, I mean, there's still some brokers out there, but retail is pretty much, where it is. So when you're looking to apply for a mortgage, you're calling me directly and I'm taking your application and getting you approved, getting the loan inside.
okay. Okay. That's awesome. So, did your mom inspire you because she was in the market and you seen how successful she was, and you just felt like, hey, I want to follow suit? Is that what really inspired you to do the lending thing?
Well, my mom's on the operations side, right? So she's underwriting management. So I do, ask her a ton of questions all the time.
Mhm.
But yeah, I mean, it always looked so, great and busy. I mean, when I first started, we would work till like 10 o'clock at night and they would, you know, cater food in, and it was popping back then, man. The mortgage business was crazy. I mean, I remember being in an office with like 50 people. American Mortgage Network, that was my first mortgage job, and it was just, loans would flow, like 100 loans a day would just flow in the door, and it was
Jeez.
just
A
it was
different
crazy.
time.
It was crazy.
It was
Yeah,
a different time for sure.
yeah,
22 years you've been in this business. That's hard to believe. That's
yeah.
hard to believe.
Over 20 years. It's crazy. So I've been doing this particular role as a loan originator for about 13 years.
Okay. Okay.
Mhm.
Jeez. All right. Well, you look awesome for doing this for 22 years. I wouldn't
Yeah.
believe that, but
Thank you.
your education and your experience shows it. So I believe
Thank
it.
you.
I believe it. So one of the questions that well, again, let me explain this. This whole podcast, I'm doing it for not only myself and the knowledge of to better my career. It's for more so the people that I speak to and whoever else comes across this, just to give them knowledge. And I want to be able to speak on topics and explain them to a third grader. I want to be able to break it down that simple. So when I'm throwing these questions at you, you don't have to get too direct, too specific.
Mhm.
I just want, the general answers, and, I want to be able to break it down to everybody. So one of the first questions I want to ask you, being a lender, there's different types of mortgages people could get, right? And I think there's four main ones as far as like a FHA, a VA, conventional, and there's one more,
USDA.
USDA. All
Hmm.
right. Could you tell me a little bit about those, and do you
Yeah.
offer all of those?
We do offer all of those, and those, are some of the main programs, but there are a ton of mortgage products out there. There's pretty much a product for everyone, right? So the conventional loans are pretty much backed by Fannie Mae, Freddie Mac, just different guidelines than the government loans that, VA, USDA, FHA are considered government loans. And all the programs have different requirements, different guidelines, different credit score requirements, right? So as you're calling in as a customer, right, we're looking at all of those items, your credit score, what's in the body of your credit, your debt to income ratio, and what works the best for you, right? And there could be people that qualify for all of those programs, but at the end of the day, what makes the most sense to you as far as your down payment, what your payment is going to be, because the rates and everything like that are going to be all different, right? Obviously, if you're a veteran, VA is a great mortgage program. You can potentially put down no money, 0% down payment if you are a veteran, and there's no PMI. And PMI, to break that down, is private mortgage insurance. So if you are not putting down 20% in most mortgage products, typically you're going to have some sort of mortgage insurance, which is not insurance for you, it's insurance for us as the lender, because if you default on that loan, that mortgage insurance kicks in and helps us as a lender for some of that loss recovery, right? So those are for main programs, but then there are also, a lot of first-time home buyer programs out there with either minimum or no down payment options. There's Chafa. Right now, Time to Own is a huge product that you hear everybody talking about, right? And so those are first-time home buyer programs that also have income limits to them. So you can't make more than a certain amount per county. Everybody's a little different. The counties are a little different. And so as we're qualifying, if you do fit into those programs, you can potentially get either up to 25,000 or up to 50,000, depending on where you're looking. The main thing about that program is that you have to be a Connecticut resident for 3 years. First-time home buyer, unless you're looking in a targeted area, there are certain areas that you do not have to be a first-time home buyer for. You just can't own anything at the time of closing. But it's forgiven after 10 years. So it's not totally free money. It's forgiven at a rate of 10% every year. So if you sold or tried to refinance, let's say year 5, you do still owe like half of that money back to that second mortgage that's there. After 10 years, it's totally forgiven for the time to own. So there are those first-time home buyer options where you could potentially get help with your down payment and closing costs. There are loan programs for self-employed people that maybe that bottom line income after all the expenses is not enough to qualify for a regular full documentation loan. So we'll look at bank statements instead of tax returns, or we'll look at a 1099 instead of tax returns. So for the self-employed, there are programs for those people as well. Rates are a little higher. Down payment is usually at least 10% down, but those programs are out there. There's ITIN loans for people that are here. They don't have a social security number, but they are working and can show proof of income and they have their ITIN paperwork. There's products for them. And those can also be combined with like bank statement types of loans. So, there's a product for that. And for the investors, there are a ton of different options out there as well, where you might not even have to show any income as long as you are, an investor and you have the experience with that, where the cash flow of the property covers itself. So if the rent is going to cover the mortgage payment, that's how they're qualified. So there's a mortgage product for everyone if you fit the requirements, credit
Wow,
score, etc.
that's enough alone for people to want to, sit down and take some of your time.
Yeah.
You could get into a house for probably nothing if you just qualify for it.
Close to it. I mean, I always say, even with the down payment assistance, you do have to have some money, right? Because
Right.
when you are putting in an offer, you have to put down a deposit and you're not getting that assistance up front, right? You're not getting that assistance till you close. So generally, even if people are getting down payment assistance, you have to have at least that 1%, right? At the time of signing the contract. I always tell people you need to have your 1%, and you should have about another $1,000 or so of inspection and appraisal money, because those are things that you're going to have to pay for out of your pocket as well until you get to.
Appraisal's not with the loan? I mean, with the,
So the appraisal is part of your closing costs, but we take an appraisal payment, and I think most lenders do take an appraisal payment upfront, because if something goes sideways, that appraiser still has to get paid, right? So it's still the borrower's obligation to pay for the appraisal.
so that brings me to closing costs associated with mortgage, because that's something that, has to be explained to people as far
Mhm.
as when buyers are looking to buy, we hear down payment all the time, and we think that, that's all that we have to pay, and but there's more than just a down payment. There's closing costs which are separate from the down payment.
Right.
So what are the closing costs associated with the mortgage, and do they differ from the different types of mortgages that you were explaining, as far as like a USDA mortgage and a conventional? Are the closing costs different when it comes to those products?
They are. The main difference would be probably in this market, like the points, right? And a point is 1%, each point, and sometimes it's not even a straight like 1 point. It might be, 3/4 of a point or a point and a half. And that's trying to get you into a rate, right? That's manageable. You can buy down the rate by paying points. In a normal market, right? COVID time or pre-COVID, we're trying to look at the rate that's not really costing any points, right? Back then, we had rates available that didn't really cost points. If you wanted to pay a point and buy the rate down, that was optional, but you didn't get too much back then for a point, right? Maybe a quarter, 3/8 of interest rate. So depending on your loan size, if your loan amount is 250, that's $2,500 of points. If your loan amount is 500,000, that's $5,000 of points. So that piece of the puzzle right now can vary because we're in a higher interest rate market.
Mm,
So, more than not in this market, people are paying some type of points, right? And that's part of your closing costs. Then you have your lender's fees, which you're processing and underwriting.
mhm.
You have an appraisal fee, right? Which is third party, whatever that particular appraiser is charging is what you're paying. You have your attorney fees. So you have an attorney representing you, and they're, charging you for representation, title search, any courier or whatever, miscellaneous fees that they have. You have prepaid items such as your homeowner's insurance, which typically you're paying that year in advance at closing, right? So if your homeowner's insurance is 1,500, that's part of your closing cost, 1,500 is paid at closing. It's still part of your mortgage payment, because as you're making your mortgage payment each month, a portion of that payment is going to your escrow account for your taxes and your insurance, so that going forward, as long as you're escrowing or including it in your mortgage payment, the mortgage company will pay those going forward. So taxes typically every 6 months, sometimes it's every quarter, depending on what town it's in, and the insurance once a year. The mortgage company will pay that going forward, but you have to come whole at closing with what's due at that point. So you're paying, your insurance premium up front, you're paying for, a good 6 to 9 months of taxes at closing as well, depending on when they're due. And, the seller usually will get back a prorated portion of what they've already prepaid. So, you're betting about, let's say, 9 months of taxes, your homeowner's insurance premium, the lender's fees, the attorney's fees. And then if you're paying points, that's also part of your closing costs. So you've got your prepaids that are just items that need to be paid, and you've got your closing cost together combined. I mean, they could range, they could heavily range, anywhere from, let's say 9,000 to 15, 16,000. It really all depends on the tax amount and the points
Yeah.
that you're paying. So, but sometimes, if you're only putting down 3%, sometimes the closing cost might be a little more than that, so that's something that we try to make sure that we're going through upfront to make sure that they know exactly how much money they're going to need at closing.
So another number that I hear a lot is to aim for 7 to 10% of the list price of the house when you're looking to buy, just in case you don't get any programs or anything like that. And that number comes from a lot of times when people are doing FHA, they're putting up 3.5% for down
Mhm.
payment. And a lot of times people would say that the closing costs will come around to the 3.5% as well, or around roughly.
Yeah, I mean, it's probably a good gauge. I mean, at a 300,000 price, right? 3.5% is just a little over 10,000, right? The closing cost could be in that range if taxes are on the lower side and maybe you're not paying so much in points. Could be more than that,
Right,
depending on
right.
those variables. So,
So
but each
7 to 10%.
property, yeah, I would say like each property, we try to give a breakdown, right, of what they're gonna have to bring between down payment and closing costs, and they could see it, and they could see all the fees that are, included in that.
And you said
'Cause
that
one
to them ahead of
property
time.
could vary from the next a lot.
Right, right. And you send that ahead of time. As soon as the client inquires about a property, you let them know with their numbers.
Yeah,
Okay, okay.
for sure.
So, what's the process of being approved for a loan? How long does a mortgage approval process typically take?
Well, that could vary too, right? So we have a link, right? An online link that we could text to the phone, we could email it to you. So if you do that and you upload all of your documentation, a lot of times you get that same day. There are situations where something might be a little sticky, where I might be unsure if something, if an underwriter is going to have an issue with something. In those files, I like to actually put into underwriting. So that might take another day or two to get an official approval. So it could be anywhere from, same day to 2, 3 days, depending on, what somebody's situation is. And if, they didn't provide all their documentation, I'm always looking at everything.
Yeah, yeah, yeah. I guess that makes sense. Um, what is refinancing?
So people refinance for a couple different reasons. Sometimes you just want a lower rate, which, in this market, people aren't refinancing for the lower rate, but they might want to take cash out. So if you have enough equity in your property to take some cash out, then you could refinance into a new mortgage and you can change the terms. Sometimes people want a shorter term. Maybe you were in a 30-year mortgage at first and you've been in it 3 years and all of a sudden the rates drop and you can have the same payment for maybe a 15-year mortgage. So people refinance sometimes for that for a lower term. You can take money out of your property if you have enough equity to do so. So sometimes, maybe the rate might be a little higher, but people need the cash to pay off some debt.
Mhm.
That's a reason as well, or just getting a lower rate when the market permits.
A lot of times, people, what you were just saying, take the cash out and they invest too, correct?
They could, or they could put a line of credit on their property without refinancing, which keeps the first mortgage in place.
Hmm.
And then the line of credit is like a second mortgage that goes on there. And it's kind of like it's like a bank. You can take the cash
I
as you need it. It's a line of credit.
see.
And there are fixed rate second loans too. So sometimes people don't like to play with the market because the lines of credit are, based on the prime rate and that can go up and down. So there are fixed second mortgages too, where you can still take out cash, but you're going to have that same payment every month for the term of that loan.
Okay. So could you explain a fixed rate and adjustable rate mortgage?
Yeah, so the fixed rate, obviously, it's a 30-year mortgage fixed at a specific rate. So the principal and interest portion of your payment doesn't change throughout the life of the loan, but that doesn't mean that your payment can't change because when taxes and insurance change, your payment can go up or down. So once a year, the mortgage company is analyzing that escrow account, and if taxes went up or insurance went up, your payment will go up a little bit. But your principal and interest portion, the money that you're borrowing will never change. That's a fixed rate. And then there are adjustable rates where, you might get a discounted rate for, then taking a 30-year fixed mortgage, but that after a specific amount of time will adjust with whatever index and margin that specific product had. And there are a lot, there are 5-year arms, 7-year arms, 10-year arms where it's fixed for that one specific term, but then it's going to adjust after that. And that will vary based on what type of product that you were locked into.
Okay. Okay. And I know you're a busy person, so lastly, let me say this. Um, if somebody were to pay off their mortgage, they hit the lottery and they just paid off their mortgage right away, do they get penalized for that, or does the lenders get penalized?
That's a good question. That they're different programs, right? So there are some programs that do specifically have prepayment penalties. So like a lot of the investor loans or the non-QM loans that we like to call them, that, they're not conventional loans and like the no income type of loans. A lot of those will have prepayment penalties, and they're aware of that. They sign documentation that they know they have a 1 or a 2 or a 3-year prepayment penalty, where if they did pay it off in that time, they do get hit with a penalty based on a certain percentage of the interest.
Okay.
Regular conventional loans, FHA loans, they do not have prepayment penalties. But us as the lender, depending on the lender that you are, like banks are a little different, but for me, right, I'm a lender, I'm a mortgage company. We sell off our loans on the secondary market. And so, typically our investors are looking to see that, they're getting 6 months of mortgage payments, because if they don't, then they could come after us as the lender for some type of penalties, not the borrower, but, it is something that, we try to be mindful of. So they can realistically, if they had a conventional loan and they, sold for whatever reason or refinanced earlier than that, there are no penalties to them, depending on the program that they were in. But if there is a prepayment penalty, they are made aware of that.
Okay. So you're looking for at least 6 months of consistent payment, at least. Hopefully.
Well, we would like that. Yeah, we can't, enforce that, but we would like, and certain programs require that, right? So like if you're in an FHA mortgage and you want to do a streamline refinance when the rates get better, which means that we're really not looking at your income or appraisal. We're just making sure that the decrease in payment meets a certain threshold for us, and the credit score requirements obviously need to be there. But that particular program, FHA wants to see that you've made 6 payments.
Right.
So, it's that particular program has that rule. Other programs don't have like a specific rule towards it, but everybody's situation is different.
Yeah. It's best just to take your time, pay it off, man. Don't pay it off too soon. Yeah. So yeah, I'm not gonna take too much more of your time today.
Okay.
Um, I look forward to seeing you in the office and maybe us doing another pod, and
Yeah.
just ending on this topic, and just delving deeper into it, and educating people more. If that would be okay with you.
Sounds good. Sounds good.
All right. Well, I'm gonna hold you to it, and I hope you have a great day. And thanks again.
Thank you.
Right now. Talk soon.
Okay.
All right. Take it easy.